Okay, so I had to restart this video, which is okay. Kind of annoying, but let's just redo this. So this video, you're going to learn about interest rates and how they actually really work, and how like the banking system works, and we'll talk a little bit about what the future holds for us. I guess you could say, right? So first and foremost, let's start off with the news. Obviously, the Fed raised 0.25% or 25 bibs, So um, what you're looking at right now is from yesterday. It doesn't reflect, um, well, actually, I'm sorry, it's from the 31st of January. It doesn't reflect an updated thing. And I'll tell you why I have the Wall Street Journal prime rate up and what that means. So, let's start off with this. Let's start off with the very basics, and I'm going to try to, no offense here, but just simplify things. Not saying that you can't keep up, but a lot of people are diving into finance. They're new, and I don't want to make them feel intimidated. I'll still use some of the big words, but I'll also clarify what they mean. So, first things first, you have the Federal Reserve at the very, 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 very top, and the Federal Reserve's job is to control the money supply and interest rates in the country. Under the Federal Reserve, you have all of the banks that are a part of the Federal Reserve System, and then under that you have me and you, which is the consumer, the citizen, and whatever else you want to call yourself. But so, how does the Federal Reserve's fund rate impact us, down here, just trying to live our ordinary life? Well, let's start at the middle, which is the banks. So, Feds, regular banks, Bank of America, Wells Fargo, Citi, all those guys, and then us, and then plus maybe your local mom and pop banks if they're a part of the system. So, the way it works is me and you deposit our hard-earned money into the banks. So let's just use Wells Fargo. Let's say we saved up $100,000 and we have $100,000 at Wells Fargo. So the way the banking system works is they're going to obviously make money by lending that money out that you gave them. And essentially, the whole system works on fractional reserves. And what does that mean? That means they only have to keep a fraction of the money that you deposit as a reserve. And of course, without getting too technical and all into it, they're all FDIC insured. So each account is insured up to $250,000. So even if the bank goes insolvent, the government will print money and make sure you got your $250,000. I think that went up to 450,000 after the financial crisis, but I always remember 250. So you deposit, let's say a bank like Wells Fargo takes in $100 million worth of deposits, all together. Now, I think the reserve rate is 18%, so they have to hold back 18% of that money. But let's just, for easier terms, let's say 20%. So Wells Fargo takes $100 million worth of deposits into its bank, from working or whatever, however, from their customers. They have to keep $20 million on hand to be able to service us, because we got to go buy expensive eggs and, whatever else, right? And the other $80 million, they're going to lend that out. And now multiply that by like billions, right? There's billions of dollars deposited. They lend billions out. But, at a certain point, that's when the bank is lending its own money or its customers' money. They consider that their own money, and they don't have to listen to anything the Fed says, whatever. They could charge whatever rate they want, right? Just because the Federal Reserve is now almost at 5%, they're at 4.75%, doesn't mean that they're gonna all of a sudden Wells Fargo is gonna go, hey, you want to buy a house, it's gonna be 11%. No, they're gonna slowly, everything's gonna come down to liquidity. And what is liquidity? It means money, right? So as me and you start feeling a little bit more of a pinch, like eggs are getting expensive, rent's going up, gas is going up, everything's going up. We're not depositing as much into these banks, and we're actually taking more money out to maintain our lifestyle than the bank, because it still has to do business. There's still going to be people that are buying and selling homes, or trying to buy businesses, trying to buy cars. So the bank is going to go to the Federal Reserve and borrow that money, and that's where all of this comes in. So now that you got a breakdown, let's summarize that of how banks works. Banks take our money, and they hold roughly 20% of it. The other 80% they lend out. And once they kind of run out of money, or don't want to lend out their customer money, they go to the Federal Reserve. So me and you, bank, Federal Reserve. They're going to go to the Federal Reserve and say, hey, let me borrow $100 million because I have to write out, these new houses, these new cars, or whatever else they got going on. The Federal Reserve will let them borrow at the Fed rate, which currently sits at 4.75% as of today. But I'm going to use easy numbers because we know the next time they meet, they're probably going to go up another 25% to 5%. So that's where this Wall Street Journal prime rate comes in. So this takes the 30 large banks, and when 23 of them, change their rate up, whatever their rate of borrow is, that's where the Wall Street Journal will land at. And today it was at 7.5%. And usually an easy way to determine what this prime rate is going to be is whatever the federal funds rate is, you could add 3%. So today, before the rate hike, it was at 4.5% plus 3% is 7.5, which was what we have right here. And eventually that's going to, and that's going to go to, 5%, because that 4.75, but we know next time they meet, they'll probably hike it another 0.25%. So 5% plus the 3% that they need to make on, their money. So they're going to be at 8%. And that 3% covers the bank, right? On loans that will default, on, underwriting fees that they have to pay their staff, and just all the other nuances that the bank has to deal with to end up at the end of the day giving you money you need to buy a house, buy a car, buy a property, whatever, right? And that's why this Wall Street Journal prime rate is very important, because if you're in real estate, which that's where I am, that's where 99% of my money is, we live and die by this number, and we have to make predictions into the future, right? Because buying real estate is not like buying stock. You buy a stock today, hey, you can dump it tomorrow, right? Cash out. You buy real estate today, it's not going to be so easy for you to close the deal. Then if you want to get out of it, it's going to be a long, strenuous process. So when I buy real estate, I think, 10, 15, 20 years down the future, and I'm thinking about, the new roofs and new tiles and new walls and paint and everything in between, and trying to factor in as much of that as I can when I'm looking at a deal to buy. Now back to this thing. So let's say federal funds rate goes to 5%, the prime rate adds 3. So this Wall Street Journal prime rate is now 8%. What does that mean for us? Now, usually you'll get 8% loans if you're a big dog, right? If you've done business with the bank and the bank knows that you have a lot of things going on, they know your cash flow is strong, they know you're a solid person to lend to, they'll probably give it to you at 8%. You could probably go buy property at 8%, right? Or even today, before this rate hike, they'll probably give you loans at 7.5%. They're happy with that, right? And if they have their own money, they might go a little bit below that. If you're really, a good customer of theirs, they'll probably give it to you at like 7%, because they're borrowing customers' money, not the Federal Reserve's money. But eventually, as liquidity starts drying up, as this economy starts slowing, those deposits slow, more banks are going to have to borrow from the Federal Reserve, and lending is going to get tighter. And, at 5%, plus 3 is 8%. And then if you're a regular person trying to get started, they usually charge 1.25% on top of that, right? So then your rate is actually 9.25%. And then that is kind of crazy, because those payments are going to be massive. So what does all this mean? What are we trying to really figure out here? And really, here's the thing, is there's a lot of things to look at, but I don't think we need to complicate things. Complications is not rocket science, right? If you develop a thesis for investing, it needs to be plain and simple. And you should be able to tell, maybe a 6-year-old's too young, but like a teenager, if you could explain it to a teenager, then your ideas, your thoughts, your thesis, your principles on why you're buying something will make you feel better about buying it, right? So let's talk about inflation. And first off, guys, inflation is devastating, and I don't think people really understand the compound effect. And I've tried to mess with the calculator, so let's just do this real quick. So let's say something cost $100 1 year, right? And inflation's at 7%, so it's going to make it go up $7. So you got to add $100 back in. So now that good, or that commodity, or whatever it is now is $107, right? But if we have 7% inflation again, you got to multiply that. Now it's up another $7.49, and you got to add the 107 original cost, right? Now you're at 114.49. And now let's say inflation this year wraps up at, let's say, 5%, right? 0.05. So 114.49. So you got to add 114.49. 3 years in, 3 years ago, a thing that cost $100 now cost $120.21. We've seen, where's that extra $20 coming from? That extra $20 is coming from your pocket. It's coming from your savings, right? And this is the invisible tax that governments, produce, because they're gonna figure out a way to stifle your savings out, and it destroys people that are saving, but it rewards people that are in business or that are in a aspect that can keep up with this, right? Because if you own rental properties, you could bump the rent. You could still afford that thing that cost $100, right? Like if this can of seltzer cost $100 3 years ago, but then it cost 107 the next year. Well, then, and if I was a store that was selling it, well, I'm going to charge 107, 108 probably, right? But you as a regular person are going to get screwed. You're going to have to figure out how, because you only have a fixed income. If you don't have any other way of money coming in, they're leeching off of you. They're destroying you. They're destroying your savings, right? And that's why inflation is so dangerous, because eventually, if this number keeps compounding the way it needs to, things get dramatically out of hand. And then you wake up one day and you're like, screw this, bro. Why am I busting my ass for 50 hours a week? And I can't even afford to buy a can of seltzer anymore. You know what I mean? Like, and that is the most destructive thing to society, and that is the thing that cripples society, and that's why inflation is so dangerous. So to combat this, what do we do? Well, naturally, what you would have to do is, and to get things right, you want to bring interest rates up so high that it just crushes demand, right? Like nobody wants this stupid seltzer anymore, right? Because you can't afford it or whatever, and things are getting so expensive that eventually the demand for seltzer goes back down, and it goes back down to about $100. And inflation overall cools. Or what we're trying to get is, we're trying to stop it. We're trying to say, shit, okay, this can of seltzer got to $120. Let's just try to keep it at $120. Let's only try to raise it 3%, right, every year, right? Not 8%, 9%. When that compounds, look at how much it got to, versus if inflation was intact, and that was 3 years, it got to $120. If inflation was intact and you got this at 0.03, it's $3 plus 100. Okay, that's not bad. It's 103. Then you times that by 0.03 again. So now it's 309 plus 103. And as you can see, it's only 106.9, which is still, and then if you compound it again, it'll probably get to maybe about 110 or 110 something. And that's way, that's at least, catch upable for the regular person working, versus 120. That gap starts to fill out, and that's why inflation is dangerous. So what does all this shit mean to us? Like, come on, bring it back to reality. So I'll bring it back to reality, which means if inflation right now is hovering around 6%, the way to destroy it is, the Fed's tool is, they're going to raise those rates until, inflation goes below. And that's when things will start coming down. And everything takes time. It's not going to happen overnight. So as you can see, inflation's on a downward trajectory, right? And with rates going up, unemployment's going to go up. So that's why I don't understand what's going on with the stock market, why it's going up and all that. What we're in store for, guys, is things are going to naturally have to come down. It's mathematics. I mean, you could do this, you could do that, you could, yeah. But at the end of the day, it's like, 1 plus 1 is still going to be equaling 2. You know what I'm saying? It's not going to, you're not going to be able to trick what's real. So this rate, this federal funds rate, is going to have to go and match, and here's the good part. The fact that inflation went from like 7.2, 7.3 all the way down to like 6.5 almost now, and it's coming down, that's good. That allows the Fed not to do 50-point basis hikes anymore. That allows them only to do 25% and just kind of slow things down. Because if they over leverage and they destroy things too fast, that's bad too. But they're in a sticky position. I personally do not think that they could stop until at least the federal funds rate is at probably 6%. Because I think by the end of this year, inflation will be below 6%. I mean, we're talking like, probably November, December time of 2023. And when that happens, and you actually see prices come down and you see things come back back to reality, then the Fed could start cutting the discount rate and bringing it down with inflation, and we get to a normal. And no, it's not going to be a soft landing, because let me tell you something. We're still going to have to transact. We're still going to have to do business. Life is still going to have to go on. So if today the Wall Street Journal Prime is at 7.5 and it's about to be 7.75, right? Because the base hike, the 25 base hike that we get, and I'm projecting that it's going to be probably 6% before it's all said and done. So think about this, 6%, right? 6%. plus 3% for Wall Street Journal Prime. That's 9 plus 1.25% for the bank to charge you, the regular person. You're looking at interest rates going above 10%, 10 and a quarter, 10%. And that is a lot. Like, I mean, you do like whatever your mortgage was, it will probably triple. So if you're paying $2,500 for a house and a $400,000 house at, 3 point something percent interest rate or 4% interest rate, you're probably going to go up 2.5 times that. Your mortgage, like, people are not going to be able to afford that. So what happens? The price of things has to come down, and it will come down. Because mathematically, it's not going to make sense for anybody, right? Because when we're making a decision on a home, we're making a decision on a rental property, we're making decisions on our life, we're thinking, or I hope to God you're thinking, 5, 10, 15 years down the road. And there's no guarantee that, rates are going to go back down. I don't think rates are ever going to come back down to, 2%, 3%, for me and you to be able to borrow. I just don't see that happening. I see what most likely will happen is, this whole year they're not going to cut. They'll probably go to 6%. And then next year, once inflation's below 5, they'll start cutting. And they'll probably stop at around like 3% federal funds rate. So 3% federal funds rate, 3% for the prime rate. And that you're looking at 6%. And then you're probably looking at about 1.5% for whatever borrow that mean you got to do. You're looking at an average rate being around anywhere from 6.5 to 7.5% to buy a home, to buy a business, to buy real estate. That's in 2024. In 2023, you're probably going to be looking anywhere from like 9. Yeah, that's crazy. Like 8.5, 9 to higher 10 or 10. And what does that mean for this year? This year, it means if you're buying anything, you need to be buying at, a 10 cap because here's why, because, these are, this bond, 30-year bond, was issued on the 17th at 4%. This bond was issued on the 31st, 20-year at 4%. So now that the federal funds rate is, 4.75, creeping into 5, eventually the next time the U.S. government goes to sell its bond, right, to borrow, to pay whatever the hell they got, to pay for Ukraine, to pay for whatever it is, this bond is going to be probably at like 5%, maybe a little bit higher. So ask yourself this question. If you had $100,000 in your bank account, why would you go buy anything in the market today that's not going to return you double what this federal funds rate is? Because this is risk-free, right? Like dollar to dollar, right? Because if you buy this 20-year bond today and you put $100,000 down, this means that you're going to earn $4,000 a year every single year for the next 20 years. And you have no stress. You have no headache. Only thing you got to do is cash the check, or probably will be direct deposit, whatever it's going to be, right? Why would you go buy any stock? Why would you go buy any piece of real estate or any business if you weren't going to make double that? Because you're asking me to take risk. You're asking me to take my hard-earned $100,000 and put it into something where there's a possibility I can lose it all, right? If I buy this bond, I'm not losing nothing. I'm guaranteed to collect the check. And if this bond goes to 5, 6%, I mean, it's going to be very hard for me to justify putting $100,000 into any stock when I know that I'm going to be earning 6 racks a year and I have no risk. I have no tension, no tenants calling about toilets or talking about replacing a window or having to replace a roof or having to evict people, or even as a business owner, having this break or having this employee not show up or having this cost go up. It's like, I got money. I'm just going to put it here. I'm going to earn. If you had $1 million and you put it here and it's at 5%, you're earning $50,000 a year for the next 20 years, the next 30 years. It's like, what? And at the end of it, you get your cash back and then you can see where the market's at. I mean, that's like a no-brainer, right? And that's why I think that, like I posted the other day about $5 trillion and BOFA's investment funds are sitting on the side that's parked. Those money managers and those people that have that excess capital, they're going to be looking around too, and they're going to be like, well, we could take a risk on, XYZ company, or we could take a risk on real estate. But if I have $100 million and I'm guaranteed to make 5%, 6% on that, I'm going to park it. I'm like, yeah, no, thank you. Smart people take the guarantee in life, guys. Let's be honest. If you're smart, and if you're money-minded, you're going to take the guaranteed thing versus the risk thing. And sometimes you see these crazy business guys where risk works out. But I do know a lot of rich people. And almost all the rich people I know, yeah, they took risks. They took calculated risks. But if you told them with their money that there's a chance of guaranteed 5 to 6% return, and then there's a maybe 7, 8, 10% here, they're going to take the guarantee. Majority of the time, people are going to take the guarantee. So what does that mean for overall for asset prices such as real estate and stocks and all that? Guys, things are going to have to come down. And I know that the market right now is irrational, that it's going up, and people are viewing this as like, oh wow, like they're only doing 25. They're gonna slow down. It's like, okay, go ahead. I mean, at the end of the day, it's like, you don't have to buy everything. You don't have to do, you got to do what makes sense for you. You don't have to listen to anybody else. Screw what everything else is doing. You got to focus on you, your family, and what's going to be in your financial best interest, right? So every deal I'm looking at right now for real estate, like if it's not going to be a slam dunk, like 5 to 10 years down the road, like if I'm looking at a deal and I'm like, yeah, I can't make 100% return, in these 10 years, I'm not even considering it. I'm like, dude, get the hell out of here. And you look on LoopNet, you look on these guys, they're trying to sell things like it's still priced in like early or late 2021, early 2022. And it's like, bro, it's 2023 now. That's the rate bar right there. 7.5%. That's what we're paying. So I'm not going to take your headache on, right? I'm not a nice guy. Like I am a nice guy in life. I'm not a nice guy in business like that where I'm going to, put myself at a disadvantage. It's like, you want to sell something. Well, this is what it's worth because this is what I have to pay when I borrow. And we're not going to be able to do business unless we meet in the middle. And, to wrap all this up and what all this means is that exactly is, number one, the inflation in this country is still high. The way to combat that inflation is to have our federal funds rate match the rate of inflation until that rate of inflation drops. Then the Federal Reserve will think about cutting. For us, all we need to know is whatever the Federal Reserve, rate is, you add 3% because that's probably what's going to be for the Wall Street Journal prime rate because the 30 largest banks are probably in consensus going to move up, and it's usually about 3%. And on top of that, when me and you go borrow, if we're not big hitters, we're going to pay 1.25% on top of whatever this Wall Street Journal prime number is. So I fully expect, on a bullish side, that we stop at probably 5.5%, and then it's 8.5 for us to borrow, and then plus one is 9.75. So that's the bullish side. The bearish side, it goes to 6%, and we're borrowing at 10. So I fully expect this year interest rates to be in the range of, if you're buying a house, a home, a business, whatever, this year, the range is going to be from 9 to 10.5. Like that's like the range. And until inflation takes a hit and it comes way back down, those rates will go down. When those rates go down, I'm expecting, our rate to borrow to be around 6 to 7.5. And that's going to be the future probably for the rest of this decade, unless something goes, just something goes unhinged and it goes crazy and then the Fed needs to add liquidity. That's the only time. But if that happens, you're talking more, in my opinion, my personal opinion, you're talking more about a dollar crisis. And at that point, everything's out the window. None of this matters. It's all going to be funny money and we're going to turn it into Japan, right? But for right now, all we need to know is things are still priced very high. They're still priced like rates are at 5%. And reality is they're not. Rates right now, you're probably looking at about an 8% rate if you go buy. So over the next, up until the summer, you're going to see real estate go into the 8 caps. You're going to see companies slowly start coming down. And where do I expect the S&P 500 to be? I expect it to fully be under 3,500 or SPY to be under $350. Now, I could be dead wrong because there is a lot of money out there and they might be thinking, we could hold this for 2 or 3 years. But once again, if I had a lot of money, I'm sorry, but I'm buying the bond. I'm just not. I mean, I'm going to take the guarantee, bro. Like, I'm not going to be risking anything, right? But hey, everybody has their own opinions, their own outlooks. These are all my opinions. This is how I see the outlook. And, hey, I hope you learned something from this. If you did, freaking fantastic. Thank you guys for sharing my content and making the page grow. I really appreciate it. And hey, join the Discord, guys. It's $5 a month. It's $60 a year. We post all of our trades. Probably 1 or 2 trades you could probably make your money back, or it's just a way for you to support me from continuing to motivating me to continue to make these videos and post content where you learn. Anyways, I appreciate you guys so much. Thanks for following, and yeah, share this if you can, and drop some comments if you have any questions. But this is pretty much where I stand on things and how I think things are going to go.